Good morning, and thanks so much for tuning in. You're watching Trade Talk on BK Prime. My name is Alex Matthew, and with me is Hiral Dadia. Morning, Hiral.
Good morning, Alex.
Well, there's clearly lots to talk about in India, but then I think a lot of the action that we're talking about this morning has come from around the world. Overnight in the US, you have Moody's that downgraded 10 small and mid sized banks because of several concerns that they have voiced. And also, data coming from China points that they've slipped into deflation. Exports have slumped in the month of July. And there's also several other factors, including a large developer in the US that has missed bond payments, and there's a worry about a default there. Could it be another Evergrande in the making?
Absolutely.
So lots to talk about today.
Absolutely. And with all of this, what does this actually tell you specifically with the bigger markets, and its impact on emerging markets is something what we need to ascertain from here on?
No, certainly. We've got Santosh Rao joining in, and he's joining in all the way from the US. Really appreciate him taking the time. Santosh, thank you so much for joining us this morning here in India. But, you heard what I was talking about at the start, and let's talk about the update from the US, which is the Moody's action on those 10 banks and the warning that there could be more to follow. Is this a sign of things to come? Are these the first signs of worry for the US markets?
Yes, thank you for having me. This has been a concern. I think this downgrade was probably delayed. It was expected, should have come way earlier when this crisis happened with the banks and all that earlier this year. So I think they're kind of delayed, but definitely it's a shot across the bow, like they say. There's a warning shot. Things are potentially expected to get worse. We already see some today's articles. Apartment owners are having problem meeting their debt payments, and so the commercial real estate market is slowly feeling the heat. And the regional banks are the big lenders to all these commercial real estates in other towns away from New York and other places. So I think that's definitely is being watched. It's very vulnerable to further shocks. So I think this was expected, came slightly later than what we thought when we thought it would come, but definitely needed that. I think it's a cautionary thing. People need to really take that into account and not get ahead of the market, because there is a sense in the US that maybe things are just we're out of danger and it's all clear from here, or getting to clear, that Fed is done raising rates, and the worst may be behind us. But I don't think so. I think the lag effect, and Chairman Powell said that. He said, don't be too complacent because the lag effect has not been felt yet. So I think that's the big thing. It's end of the raising cycle, but it's the beginning of the lag effect cycle. So lag effect impact. So I think we're going to see some. The second half is going to be you've got to be very careful. There's a lot of issues with the real estate market, the commercial real estate market. People took out too many loans at low interest rate, and now the bills are coming due.
Absolutely. Santosh, to add to that, very rightly pointed out that with the collapse of the Silicon Valley as well as the Signature Bank, that has come off late. You've already seen, S&P, which has gone ahead and downgraded US. Now we are talking about Moody's, which has just downgraded 10 banks. A lot of others may follow suit. Now, you mentioned about the strain in terms of commercial real estate. This coupled with the credit card delinquencies, which are actually increasing in the US. I mean, the debt has topped almost $1 trillion now. Would this actually mean that the risk off is now back?
Yes. It's still the market hasn't bought in yet, because there is a hope rather in the market that Fed will start cutting rates. We don't think so. I'm in the camp that it's not going to happen. They're going to be higher for longer. They may not be raising much, maybe one at the most, but not anymore. We are at the point, and after these downgrades and the Fitch downgrade as well, I think people are. I think the Federal Reserve is going to take that into account. That we don't want the economy to go in a tailspin if the rates go too high. So already the demand. He wants to weaken the demand side of the equation, which he's slowly succeeding. But as long as the unemployment claims numbers remains at this low level and doesn't rise too much, I think things are still okay. The consumer is still okay in the US, still spending. So inflation is rolling over. So things like that. So there are the wage growth is happening. Employment labor market is still tight. So the fundamentals are still okay. The only thing that will break it, and that's what the people are worried about, that the Fed might go too far and start breaking things. At this point, it has not happened, which is a good thing. So let's hope that happens. But it's definitely there is stress in the market, credit tightening going on, lending standards have gone up. So slowly you'll start seeing demand go down more and more. But at this point, there are some technical issues coming to play here as well. Because people have their mortgages at very low rates, and if they have to refinance or move out or buy a new home, the interest rates are very high. So no one's making those moves. So the demand for housing is down, but because of shortage supply, it still remains high. So there's some technical issues playing out there, but net, I think the pressure is to the downside. So things will slow down, definitely. We are in the camp. I'm in the camp that we will have a recession, though it will be shallow and short. That's
Okay.
my
all right. And I think a lot of people are coming back to that way of thinking as well. Interesting that you point out the lag effect, because to my mind, what I was thinking of is physics, where you have inertia and possibility of whiplash. But let's talk about China as well, and the fact that there are a lot of developments. Seemingly, the efforts of the Chinese government to bolster the real estate space, which has been under pressure for quite a while, has failed. Because you have the latest real estate company, that is Country Garden, which was at one point the largest in that country. It has missed bond payments. It has 30 days to make good on them, but it's got a lot of repayments due at the end of the year. So you could have one more default coming our way. And at the same time, you have exports slumping, you have the prices dropping, both on the producer side as well as on the consumer side. Not looking good. But what does that mean for flows, for capital flows? Already money has been flowing out of China.
Yeah. Before I get there, on a broader scale, China's resurgence or recovery has been a disappointment for the rest of the world. We expected things to really come back to life, but everything is slow out there. They have a classic housing bubble there, and because of all the and you're going to see the demand side of the equation is very soft there. So the housing market is down, and these guys owe money. The builders do. So I think all those things are going to happen. It's happening in the U.S. also to some extent, but it's controlled, or that's what we think so far. But in China, it really started in 2021 when they cracked down on the developers at that point, and then it still hasn't recovered yet. So I think you're going to see that continue. It'll go on for a few more years, I think, looks like at this point. Though I'm not very precise on the Chinese economy in terms of the timeline, but definitely the weakness is expected to linger for quite some time, because they need to shake out all this excess supply and no demand. So and all these ballooning debt payments that are coming due, and they don't have the money to pay that. So I think so that's what's happening. And then even the people, they're walking away from their mortgages, just like it happened in the US in 2007, 2008, where people walked away. Their mortgage is way above the value of the houses. So I think that's what happens when the supply demand imbalance happens, and that's what's going on. So export prices, like you said, it's down. It's just the overall weakness of the Chinese economy that's playing into all these exports and the debt crisis there.
Right. So, Santosh, and just before I take my last question to you, I'll correct myself. I mentioned about S&P downgrading. It was about Fitch downgrading US recently. But apart from that, with the entire setup that we're looking at in terms of the global markets, in terms of Asian markets as well, what is the kind of impact you're seeing on emerging markets specifically from an India perspective?
Yeah, I mean, I follow Indian news quite a bit. I think the Indian economy is still very resilient, so it's doing well. I don't see any knock-on effect there from this. because the dollar is coming down. It's not very high, so that helps the overall market. Emerging markets benefit as well. But India has been an island unto itself. It's doing very well. So I don't see an effect there. Maybe in other emerging markets, the commodity, the companies that are, the countries that export a lot of commodities, I think they can see a benefit if the dollar continues to fall and interest rates can fall, start coming down and not keep going up. So I think all that should have a knock-on effect, beneficial knock-on effect on the emerging markets. So let's see where that plays out. But as of now, I think the emerging market is fairly stable at this point. We haven't seen anything broken there, though inflation is still high in Europe and other areas. But the emerging markets, not as much, even though there is inflation across the board. But I think it's well controlled, especially in India.
Right. Thanks, Santosh, for getting us all the information and, talking to us as well about various macro aspects that we are looking at currently, and wish you a very good night as well from India. So that's with regards to where, overall the global markets go. But it's interesting, Alex, to see what's going to happen in the Indian markets. We have the RBI meeting, which is underway currently as well. And tomorrow is the policy. It's going to be interesting what the RBI does tomorrow, because the overall expectation is pretty much status quo, right?
Yeah,
exactly. So, clearly it's going to be interesting to see whether any of this impacts our markets as well. But overall, just a quick one in terms of the markets. Clearly, it was a volatile session yesterday. A narrow range is what we've seen in yesterday's markets. And you had the broader markets, which have clearly outperformed. Bank Nifty actually has failed to go above those 45,000 levels. And this is for a fourth consecutive session. If you see in terms of the options data as well, there has been aggressive call writing at 19,600 and 19,650. So, it's unlikely that Nifty will actually gain the momentum unless you see call writers exiting those 19,600 levels. So the setup is also looking like that of consolidation, and I think that's something which will continue.
Consolidation continues to be the name of the game. I've said this several times, I think, over the last couple of weeks. And I guess the big macro event, as you pointed out, is the RBI monetary policy. That will be out of the way tomorrow. Do remember to tune in live. I will remind you tomorrow as well. But in the meanwhile, let's turn to earnings. And we've got Vikas joining in to give you some perspective on Coal India, which has reported its Q1 results. Vikas, good morning. What are the key highlights that you're picking up?
Yeah, good morning, Alex. Very much online or expected lines, the results of Coal India has been. Although the revenues have beaten estimates and it's risen by 2.5%, and the analysts had expected it to be only a marginal rise, it's mostly on higher production and as well as volumes, offtake that happened during the quarter despite rains affecting the initial part of the quarter. But overall, as far as EBITDA margins and the net profit is concerned, it's missed the estimates and also it's fallen during the quarter. So EBITDA basically is down by 14% to 10,500 crore compared to 12,250 crores last year. It's mostly on a higher employee cost. Although the employee cost has fallen compared to last year, but it's still on a very higher level at around 12,000 crore. And last year it was around 10,000 crore. EBITDA margin has also fallen down by 570 basis points on lower realization. The blended cost of coal or the price is basically fallen compared to last year. So although the average price of selling price of coal is higher by 7%, the blended, which includes the e-auction price, it's lower compared to last year. And net profit also has fallen compared to last year. It's down by 10% to 7,941 crore, mostly because of lower operating margins. Analysts believe that full year FY24 is going to be much better compared to last year, mostly because of higher volumes and offtake as far as e-auctions are concerned, because there will be surplus coal available because of a higher target of 780 million tons that Coal India has set for FY24. Thank you very much.
Thanks, Vikas, for getting us the details. An interesting fact that we need to pick up over here is that though the profitability has dipped this time around, the full year numbers are going to be interesting to watch out for, and that's what the street is expected to eye from here on. But moving on, a whole host of numbers that have been reported from the broader markets as well. We will have three of our researchers who will be getting us all the number crunching. First on the line, we have Himansh standing by with more. Himansh, good morning.
Good morning.
What's on your list today?
So, quite a mixed bag of results. I'm starting with Star Cement, where the revenues were in line, margins were compressed, but the profits were still a beat. The net profit was up by 38% year on year, and it was missed. It was above Bloomberg estimates by about 7 crores. Then we have Utkarsh Small Finance Bank, which recently hit the markets last month. The margins are seen to come down sequentially from 9.7 to 9.4 to 9.2 this quarter, but the PAT has seen a jump of 20% year on year. Notably, other income was higher by almost 9% and provisions were lower by 16%. Asset quality also improved on a sequential basis as the numbers reflect on the non-performing ratio numbers. Then Dish TV, the upset in margins and revenue trickled down to the EBITDA, which was down by about 34%. Yet, PAT is up by 15% over the last year. Dish TV also appointed a new CEO, Mr. Manoj Dobal, who will be assuming the role from August 23rd after getting the necessary government approvals. Then we also have Prestige Estates, where the revenue took a note down of about 13%, and it also missed Bloomberg estimates by around 600 crores. However, the PAT again surprised by a 30% jump over the last year and also beat the Bloomberg estimates. Then we have Gujarat Alkalis, where the sharp decline in profits before tax for the quarter compared to the last year, was mainly because of the adverse market conditions in the caustic chlorine segment, leading to a substantial reduction in prices, both witnessed domestically and internationally. So these are all the earnings summed up for the mixed bag of stocks, and let's see how the market reacts to these today.
Particularly the last one that you mentioned. Thank you so much, Himansh, for joining in. Gujarat Alkali is one to watch a loss and very significant deterioration.
Exactly.
In the earnings.
There could be a negative reaction coming in there.
Certainly. There are lots more earnings. We're heading into the last week, I think, of the earnings season. As is normally the case, there is a flurry towards the end. We've got Mihika joining in to tell you more. Mihika, what's on your list today?
Good morning. Yes. So first we have Phoenix Mills, which beat analyst estimates on all fronts, while revenues and EBITDAs were up 41 and 52.5% respectively. Margins improved by 451 basis points, and the company's net profit saw 61% fall in this quarter. Both total consumption and the retail collection saw an 18% year-on-year growth to 2,573.8 crores and to 613.6 crores. Even the commercial offices also saw 11% year-on-year growth. The quarter also showed strong leasing traction with gross leasing of 1.76 lakh square feet, out of which 0.88 lakhs square feet is new leasing and 0.87 lakhs was renewals. Then we have Oil India that beat estimates in terms of revenues, EBITDA and net profit. However, all the numbers saw a percentage fall in comparison from the year ago period. Revenue was down 21%, EBITDA was down 35%, and margin saw 796 basis point degrowth. Next, we have Eureka Forbes that the company saw the revenue was down 4.1% this quarter. However, EBITDA and net profit were up 9% and 28.5% respectively. The company also reached a record high EBITDA of 10% this quarter. Next, we have Jai Bharat Maruti. Revenue was down 4%. However, EBITDA was also down 34% and net profit was also down 35%. Margins also saw 3% fall this quarter. The company's board has also approved a stock split of existing shares in the 5:2 ratio. The purpose of the stock split is to enhance the liquidity of the company's equity shares. Then we have Suven Pharmaceuticals. The company saw marginal revenue growth of 1.5%. EBITDA and net profit were both up and the margin saw 371 basis point improvement. And lastly, we have Sudarshan Chemical Industries. The company's profit was up largely by 3,672.3%. Revenue was, however, up 9.7% and EBITDA was up 69% this quarter. The company is the largest pigment producer in India and exports to over 85 countries. Domestic and non-specialty segment revenue saw year-on-year degrowth this quarter. However, the domestic revenue is expected to pick up in the second half of the year. Export revenue was up up 5%, and the specialty revenue was up 3% year on year this quarter.
So that's going to be an interesting one. Thanks, Mika, for getting us the details. So Sudarshan Chemicals is something we will be eyeing. I think it's the last one, which is a blockbuster in Mika's list, whereas Himanshu's list had the Gujarat Alkalis, which was a downer. But moving on, we have Saloni also standing by with a whole host of numbers. I think you're tracking Siemens, Dhampur, Aarti Industries, etc. How have the numbers been, Saloni?
So first we've got Birla Corps that narrowly beat top line estimates, but it missed bottom line estimates by quite a margin. The net profit was marginally lower than last year due to higher depreciation and interest cost. The uptick in the revenue was mainly due to an increase of rupees 206 crore revenue from the company's cement segment. The revenues from the jute segment were more or less the same. Next, we've got India Tourism Development Corp. So the company saw a healthy growth this quarter, especially regarding its net profit. 61.2% of the company's revenues were from its hotel division as compared to around 65% last year. The international trade division revenue saw a decline, while the travel and tours and the engineering consultancy projects revenue saw a substantial rise. Third, we've got Siemens. While the company saw a growth in its revenue, EBITDA and net profit, it missed revenue estimates. The highest revenue came in from the company's smart infrastructure division, followed by energy, then digital industries, and lastly mobility division. Next, we've got EIH that saw growth across all fronts with a sharp 61% jump in its net profit. The total expenses as a percentage of the total income dropped largely from 81.2% to 72.8% this quarter, explaining the higher EBITDA margins. Fifth, we've got Dhampur Sugar Mills that saw steady growth this quarter. The 86 odd crore rise in the company's revenue is mainly attributable to the increased revenue from the sugar and ethanol segments. The power and portable spirit segments saw a fair amount of rise, while the chemical segments saw a drop in revenue from 91 odd crores a year ago to 81 crores this quarter. And lastly, we've got Aarti Industries that saw a decline in its top line and bottom line, missing all Bloomberg estimates. The EBITDA margins dropped from 17.51% a year ago to 14.21% this quarter, while the net profit margins also saw a decline from 7.72% to 4.45%.
All right, that last one is also important to watch. Thank you so much, Saloni, for getting us those details. Like I said, a flurry of earnings towards the end. But there's also stocks to watch in terms of the news that you get from notifications that get sent to the stock exchanges. And Varsha is joining in with a separate list. So, Varsha, good morning. What's on your list today?
Yeah, so there are a bunch of companies that one needs to look out for. So the first one is SBI Life Insurance. Now the company has appointed Amit Jingran as Managing Director and Chief Executive Officer of the company. The next we have is NTPC. The company's unit NTPC Renewable was a successful bidder for 80 megawatt floating solar project. Then we have Century Plyboards, which has completed the acquisition of entire stake of Pacific Plyboards. The next we have is Inox Wind Energy. Now, the promoter and promoter group entities of Inox Wind has raised almost 500 crores through the sale of equity shares via block deal. The funds raised are proposed to be infused into the Inox Wind and use it to repay the existing debt. The next we have is Lupin. Now, the drug makers unit Novel Lab has received approval from the US FDA for its abbreviated new drug application of fluocinolone acetonide oil, which is a generic equivalent of Derma.
Actually, it's a tongue twister, not a generic, I would say.
So it is actually, it is a generic equivalent of Derma Smooth of Hill Dermaceuticals. The last that we have is ICICI Lombard. Now the company has received a show cause notice on August 8 from Directorate General of GST Intelligence, alleging a tax demand of rupees 273 crore along with interest and penalty, while the company has already deposited almost 104 crore without accepting any liability in this regard.
So I think a huge list for us to follow up as well. And in fact, I think we need to keep an eye, Alex. Thanks, Varsha, for getting us these details. An eye on the insurance players as well, life insurance as well as non-life insurance players on the back of the data that has come in for the month of July. Not sure how the trend looks like so far, but it's interesting to see how the stocks will open and trade today.
And there will also be data from the mutual fund industry later today, which will give you an indication as to how flows have gone into which schemes. So far this year, very interestingly, a lot of money flowing into the broader market schemes. So small cap and mid cap schemes as of June had inflows of 28,000 crore rupees into active funds. So we'll have to see if that continues to be the case. You pointed out that at the start that there is resilience in the broader markets. To a certain extent, I guess there could be buying from domestic institutions also that could be leading to some of that resilience. But clearly, lots to talk about over the course of the day. You'll find all of that right here on BQ Prime. Do stay tuned.